Good afternoon. It's the 14th of February and welcome to BizTech Asia's Midday Market Watch. I'm your host, Jeffrey Halley. And today our guest, a long-time guest, finally returning after a long break, is Teng from Auckland in New Zealand, an independent markets analyst. Tina, great to have you back on the show.
Hey Jeff, thanks for having me again.
Okay, so let's just have a look around Asian markets before we talk to Tina. And it's been a bit of a choppy day, really, for Asia compared to yesterday. Remember that mainland China is still on holiday, although Hong Kong has returned today. Looking at the Nikkei 225, it's down 0.71%. The Hang Seng on its return is up just 0.21%. Down in Australia, the ASX 200 is down 0.87%, while South Korea's Kospi has fallen by 1.02%. In Singapore, the STI is down 0.41%, and in Kuala Lumpur, the KLCI is down 0.38%. Tina, today's market performance is a little bit of that US CPI hangover from last night. What's your take on the performance today?
I think the trigger of the sell-off is from Wall Street overnight. The US CPI came out hotter than expected. So that's triggered the market expectation that the Fed would now cut interest rates as soon as expected before. So before, I think market participants might have bets on a March rate cut. However, this data might push this time to at the earliest in June. So market just react to the data. At the same time, the record high Wall Street actually required for a technical correction as well. So stock markets might have been overvalued in the first month. I think just a combination of the factors, there is a risk of sentiment prevailing as well.
And that risk-off sentiment's reflected in bond markets as well. Yields rose and the dollar's strengthened slightly as well. As far as this risk-off sentiment goes, do you think this could represent the highs in the stock market or the lows that we saw in US bond yields? Or do you think this is a temporary aberration and that once markets have digested it for the next few days, they're going to get back to A, pricing in Fed rate cuts, and B, buying stock markets?
So I think February would be a correctionary period for the stock markets, but this stock market rally might continue after short period of correction. I think that's fundamentally the AI frenzy is still there. So the fund inflow and expectations for a rate cut by the Fed probably now it will be in the second half of the year. So there are still a lot to digest. However, I think this correction that's we can see it's a healthy correction in the stock markets, but there will be still recessionary risks ahead just because it's bond markets and there's a slowing down in probably employment worldwide. We can see the tech companies actually, most of them are doing layoffs, headcount cuts. So from macro point of view, market really could continue in the short period after this temporary correction, but second half of the year there will be some serious issues coming out from the macro background.
Right, wonderful. Now it's a fairly quiet day data-wise in Asia. We haven't really started seeing any results coming through from the Indonesian elections, but dollar rupee is almost unchanged anyway. What other data points are you looking at this week around the world?
This is relatively quite weak from the economic data, but tonight the UK CPI will be released too. There's an indicator for if the European inflation continues slowing down. And also tomorrow, Australia will report its employment data for January. So employment data, if the unemployment rate picks up a little bit, that could just reinforce the expectation for the RBA to stop rate hikes and probably sooner rate cuts. So this is the key indicator I'm looking at and assess the market trajectory.
And just touching on the RBA, they were hawkishly unchanged, is how I described it in their last meeting. Do you think that if the Australian data is weak tomorrow, that might tilt them more to a stronger easing bias?
I don't think there will be much of a major impact on their decision and hawkish stance. I think inflation is still well above the target level. I think most central banks now are sticking to a hawkish stance until they see inflation really cools down to 1 to 3%, around like 2% that level.
It could be a case of that they got it so wrong with transitory inflation going into this cycle, they'd be very reluctant to get egg on their face once again by easing too quickly. Tina, thank you so much for joining us on the program today.
Thank you, Jeff.
We've been talking to Tina Teng, independent market analyst down in Auckland, New Zealand, on BizTech's Asia Midday Market Watch. This video and podcast will be on our website, www.biztech.asia, and our social media platforms, as well as our syndication partners, TV and radio stations and websites. Please like and subscribe to our various programs. I'm Jeffrey Halley, and thanks for tuning in.